Today, we're going to take a simple and clear look at one of the most important financial statements in business. Welcome to Balance Sheet Awareness. No matter what type of business you own, understanding the balance sheet will help you see the financial health of a company at a glance. A balance sheet is simply a financial statement that provides a snapshot of your company's financial position at a specific point in time. Almost like those snapshots of you in your youth, and then you took another in your teen years and another in your adulthood. It shows you what's happened to you over time, same as the balance sheet. Your balance sheet will describe the health of your company. The balance sheet consists of three main sections: assets, which is what the company owns; liabilities, which is what your company owes; and equity, which is the value left for the owners after liabilities are subtracted from the assets. The fundamental formula of a balance sheet is assets equal liabilities plus equity. This equation must always balance, hence the name balance sheet. Let's define it again using a common example we can all understand. You purchase a house for $100,000. Your house is now your asset. You put $20,000 down on the purchase and you borrowed $80,000 from the bank. So now you have $20,000 in equity and $80,000 in liabilities to balance that equation. As you pay back the loan, make improvements on the home, or circumstances cause a loss in the home's value, the equation will adjust to show those changes. Our goal is to have healthy assets on one side and shrinking liabilities with growing equity balancing out the other side. A typical balance sheet will be structured like the one shown. It's the breakdown of the assets and liabilities along with equity types and totals of all three of those. Remember, assets are everything a company owns that has value, and they are typically divided into two categories: your current assets, which are the assets that are expected to be used up or converted into cash within a year, and long-term assets, which are assets that provide a value over a longer period of time, usually more than a year. Long-term assets can include property, equipment, buildings and fixtures, machinery, and we can also include patents, trademarks, and long-term investments in this category. Current assets are of particular interest because they're either cash or they can be converted to cash quickly. They include accounts receivable or money owed to the company, inventory, which are the products that we have on hand ready to be sold, and short-term investments. You want a healthy amount of current assets. Liabilities fall under similar categories. We have current and long-term liabilities, which represent what a company owes to others. Like assets, liabilities are also divided into two categories. Let's explore. Current liabilities, these are the debts or obligations due within usually around a year. Examples include accounts payable, which are bills the company needs to pay; short-term loans; wages that are payable, which are salaries owed to employees; and your taxes payable. Again, these are going to pop up and move away quickly, anywhere from a month to a year's time. Now let's look at long-term liabilities. These are debts or obligations that extend beyond a year. Examples of these can include your long-term loans or bonds payable, any lease obligation, or pension liabilities. These are things that are going to take you more time to pay off. And finally, the all-important equity. Why is equity so important? Because equity represents the owner's interest in the company. It's what remains after subtracting liabilities from assets. Equity is the value of the company and can include things such as shareholder equity, which is the owner's stake in the company representing the value of the investment; common stock, or the money invested by shareholders in the company; and retained earnings, which are profits that the company has kept rather than distributed as dividends; and additional paid-in capital or extra money that shareholders have paid beyond the nominal value. Equity is important because it shows the company's net worth and its financial stability. A higher equity balance generally indicates a financially healthier business. We all want a financially healthier business. The balance sheet is crucial because it helps businesses and investors in that business understand financial stability and liquidity and assess debt levels and the ability to meet obligations in the company. It also helps owners evaluate the company growth over time and make informed investment or lending decisions. To sum it up, the balance sheet is like a financial report card for a company. It shows what the business owns, which is its assets, and what it owes, which are the liabilities, and what's left over for the owners, equity. By understanding these key sections, you can better analyze a company's financial health and make smarter financial decisions. Join us for our next balance sheet session, where we talk more in depth about why you need this essential financial statement.